All right, welcome back to the Prosperity Playbook. You have Britt, Renee, and our special guest again, Christa Hudak from Co-Create Financial. If you didn't catch the last episode that we did on financial planning, definitely go back, check that out. And certainly, again, if you are looking for a good financial advisor, Christa is my personal financial advisor, and she's been a rock star for me. So we're going to dive a little bit deeper on this one. We're going to talk more about actually investing. We're going to dig a little deeper into some of the topics and the hot button questions that I get from clients a lot. But I'm going to start this off in a little bit of an unconventional way because I want to start by talking about giving, because I know that's a big part of your strategy as a financial advisor, not only making money, but being generous and charitable. And so I'll let you take it from there, Christa.
Thanks, Renee. Thanks for having me. And I'm glad we're starting here because giving and generosity is one of my favorite topics. And Renee knows that because there's just so much here to dive into and it's not talked about nearly enough. But, you know, the first thing, just framing this conversation, I always like to start with is that I heard this saying long ago, and I think it's so true, that the most sensitive nerve in your body goes from your heart to your wallet. And
that's fantastic.
And it's so true. And it's so true on multiple dimensions. Like most people think about that from the standpoint of, oh, I don't want to release my money, right? Like, oh, that's hard to do. But it actually works both directions. Like if you want to care about something more, start giving to it. It's going to change your heart. And if you want to prioritize something, make sure you fund it. One of the most powerful things Matt and I did many years ago when money was really tight for us is we actually set up a budget for relationships, for developing our friendships and all of that. So we set aside money. And we, like I said, we were on a very tight budget in this season. And so to have, you know, $100 or $200 a month that was specific for going out to dinner with somebody or having somebody over for those things just catapulted the relationships we had because we were specifically investing in them.
You guys are the best hosts. And by the way, Matt is her husband and also her business partner.
Yes,
So,
yes.
And they don't have a TV. I have to throw that out there because I think this is like the most crazy thing ever. I'm like, you guys work together all day and then you are at home together all night and you don't have a TV. Like, what do you do?
It was the best thing to get rid of the TV. I understand it if it's not everybody's thing, but it was great.
All of a sudden, you're like, we have so much time for activities because we're not just watching the TV.
Exactly. We sleep more. All kind of things. Anyway, different topic there.
Yeah,
we don't fund that.
So let's dive in a little bit more and talk about giving. So I think sometimes you know, when you're just starting out, you kind of feel like, well, maybe I need to pay myself first, which is obviously a good thing. But do you think there's a certain level you need to make before you start giving? Or do you think, I know the answer, but I'm asking you a loaded question. Do you think that you should be charitable at any level?
Absolutely. There is so much good that happens for us when we choose to give. And one of it's just putting our own finances in perspective. And choosing to step into a place of generosity is also stepping into a place of gratitude for what you already have and to recognize that there are other people that have challenges that are greater than yours or other things going on. And also just where we live, the opportunity we have as Americans, not everybody in the world has that. I mean, gosh, there's so many people in the world, I wish I could remember the stats on it, that don't even have access to a safe place to save money.
Yeah.
And so we are in such a privileged position, and it reframes our thinking about money to be giving money. And so it's always a good habit to be doing that proportional to your income on some level and choosing to invest in things that are bigger than yourself.
Well, and I think like in the last episode, you said, you know, if you aren't making good money decisions when you don't have a lot of money, you won't be making good money decisions when you have a lot of money. I think it's the same with giving, where if you're not a generous person when you don't have a lot to give, you're not going to be a generous person when you do have a lot to give.
Absolutely. And statistically, you'll be less generous when you have more money, because that's typically what happens is that as people's income grows, their percentage of giving typically declines.
That makes a lot of sense. And honestly, there's a couple things there that I want to touch on really quick. So gratitude, I think, is something that is important for all of us to do, no matter where we're at. You know, I've talked about this before where I'll get like really stressed out in my day to day. And then I look at the problems that I have right now. And, you know, I'm super busy and I've got issues with my team. I mean, 10 years ago, Renee would love to have had a team and had that much volume that she was so busy she didn't know what to do with herself. Mm-hmm. So sometimes as we are in the planning mode and we're thinking about our big goals and dreams for the future, being grateful for where we're at right now, for me, I think is a part of it. Even if it's just small daily gratitudes, making, hey, look, the sun's shining. Mm-hmm. Hey, my dog loves me so much, whatever the little things are. Like sometimes those are the big things.
Yeah, exactly. So, and I would say like, there's a lot of powerful things that you can step into as you build that giving habit, and, your giving, can increase instead of decrease as you have more resources when you build that habit. And that's a real source of joy to step in. That's something that we see very clearly, that I've seen. You can pick a generous person I've literally picked a generous person out of the crowd in New York. I'm not joking. Yeah. And because like people who are generous carry so much joy. And so choosing to step into that as you have more instead of stepping away from it is a really, really powerful strategy.
I love that. And I think I've said that a lot of times too, of even if you don't have a lot to physically give monetarily, I think it's important to do a little bit, but sometimes there's more that you can do just being, volunteering a fork and spoon, things like that. There are things that you can do to give back that make a difference that don't cost you hardly anything to do. So there's always those opportunities. And I really feel like when I've been in a funk or been down, helping somebody else is usually something that can pull me out of that faster than anything. And the other thing on that is I have said on this podcast multiple times that one of my reasons for wanting to make lots of money is to be able to give away lots of money. And we were just kind of talking about that earlier. Like, I want to be able to write big checks to charities that are important to me and say yes when they ask me for sponsorships and things like that. Like, that is a huge part. It's literally on my vision board as something, and it will be every year, even though we've tackled that in past years, it will remain on there.
It's a fun thing to get to do. It's a
so
very special thing to get to do. And
so obviously I know you can, go to any nonprofit website and make donations there. But when we're talking about giving, what are some other types of gifts that are a good idea and ones that maybe aren't such a good idea?
Yeah. So that's a fun topic. So kind of like in gifts to the people closest to you, cash is actually one of the worst gifts. It's a good gift, but there's a lot of benefit to giving things that what we call are highly appreciated. So this would be if you have a brokerage account. This is a super easy example. And you have some stocks that have a 200% gain on them. If you were to sell that, you have to pay the taxes on those stocks. And, they're taxed at a preferential rate and all of that. And it depends a lot on your tax bracket and how much you're going to sell as to how impactful that is to you. But especially for people in a higher tax bracket, that's income coming in. But if you give those stocks directly to the charity without selling them, you don't have to pay the taxes on it, but you actually get to deduct the full fair market value of those stocks. So that's why giving appreciated assets is so powerful for people in a high income tax bracket, is you essentially get a double tax benefit. And as I mentioned, stocks are a really easy one to do on that. And there's a couple different ways to do that mechanically. You can give them directly to charities, or you can even set up a giving fund, a donor advised fund, where you give to the fund, the stocks are liquidated there, and then you're able to send a check to the charity. So if the charity maybe isn't set up to receive stock donations or something like that, it can simplify the whole process. Or if you want to give to a bunch of charities, we can do it that way.
I'm so glad we're talking about this. So I was hoping we were going to bring this up because this is one of the pieces of advice you gave us last year, and it's super cool. For one thing, it made me, I was like, okay, I'm going to put $15,000 in it, or $20,000. I don't remember what it even was now. And then it was like, that means I have to go spend that money on charities. And this is really cool. Now I get to, like, at the end of the year, figure out who I want to give this money to. And again, this is called a donor advised fund, because some of the charities we gave to were like, oh yeah, we know all about donor advised funds. We know exactly how to do this. Some of them are like, I'm sorry, what? Because they're a small thing. And so setting it up through this fund that you did is just literally, they're just getting a check. They don't know any difference, but it is that double tax advantage. If you're somebody that has highly appreciated assets, like she said, we had some stocks that they were like, this is time for us to sell these anyway. It's at the end of its useful life. This avoided taxes, and it helped me be able to give those big checks that I wanted to.
Yeah. And it's one of the neat things about it too, is that even if you were to buy the same stocks back, like let's say we're like, hey, we still love this stock and you're going to dump more money into your account. And, but this is highly appreciated. We're going to donate this and we're going to buy more of it. Then it's set at that higher cost basis. So there will be fewer taxes on it in the future. And there's no, for any investing tax nerds, and there's no wash rules in that. So you'll be able to give that and reset that tax basis without a problem.
Love it. I think that's so smart. So if your financial advisor has not talked to you about that and you've got significant assets, especially in stocks, it's definitely something that to talk to them about, or just call Christa and she'll help you with it.
Yeah. And in that vein, before we move on from that, I did want to mention, stocks are an easy one to do, but you can actually use this strategy with all kinds of assets. You can even give partial gifts of real estate, like especially if you have an income producing property. There are some donor advised funds that will work with you on that so that part of the income can come in from that and go right to charity, or you can give a whole property or a partial property when you're about ready to sell it so that part of your gain goes straight to charity and you don't have the tax as big of a tax impact.
I love
on that.
And obviously on that note as well, in back to the planning conversation a little bit, it's something to think about as you are doing your estate planning too. I find, like, for me, my dad is always talking to me about, like, oh yeah, I'm going to make sure you have this and this and this. And I'm like, I don't need any money from my dad. I'm like, Dad, pick some cool charities that mean something to you. Like, give some money away. And I think that's something to think about as well. And it's kind of a fun thing. Estate planning is not fun in general, but it is a fun thing to think like, oh, well, when something happens to me, this charity is going to get a nice little windfall. So you can do it now and you can do it later. And I think it's just a cool thing to, I don't know. It makes it
fun suggestion, especially when you're dealing with like a parent in a situation like that and you're like trying to encourage them to be charitable and maybe they feel like they're taking from you. You can encourage them to put in their estate plan a disclaimer clause that allows you to disclaim part of your inheritance to a donor advised fund that you administer. So, and that would be particularly relevant for large taxable estates.
Cool. I love that.
So that way you could encourage them to direct part of it to charity, even if they're hesitant to do so.
Love it. Well, on the same path of excellent advice that I have gotten from you in the past, another topic I want to hit on is we've always talked a lot about kind of retiring early and doing all the fun things. And so when I told you that was something that was important to us, and Christa looked at our accounts and she's like, all of your investments are in qualified plans, 401ks, IRAs. She's like, do you realize that you can't pull that money out before you're technically retirement age without having penalties and fees? And I was like, well, yeah, I know that. And then I was like, oh, oh, okay. So what's the solution for that?
Yeah, that's something that comes up a lot. And that's true whether somebody says, I want to retire early, or maybe they just have some goals before retirement. Like maybe they're planning to work, into their 60s, but they want to build a house or something like that. And so it's important that we're not just saving in your 401k or IRAs, and that we are saving in another structure that you can actually access beforehand. Because just as a refresher, retirement accounts are not accessible until you're age 59 and a half. And even then, if you're dealing with tax deferred accounts like traditional 401ks or IRAs, you pay ordinary income tax on everything you pull out of the account in retirement. And so if you're planning on pulling out big lump sums, that's going to create a big tax year. Normally, it's not a big deal if we're just pulling your normal expenditures out of that. But if you have a big expense, we might want to balance the different ways we're managing taxes on that. So what we end up doing for most of our clients, both for their other goals that are pre-retirement and also for if anybody wants to retire early, is making sure we're also saving in just a regular plain brokerage account where we can do the same types of investing within the account, but it's just in a different tax wrapper of just we pay taxes as we go. There's no benefit of putting money into the account from a tax perspective, and then each year you pay taxes on the gains that you realize in the account for that year and any income that comes into the account. What I will say on that, especially when you're taking a more longer term investment strategy in it, is most of the way we manage it, it's typically taxed at long-term tax capital gains rates, which are lower than ordinary income.
Got it. Yeah. Well, I think that is a good segue into talking about some of those tax advantaged accounts. So talk about the difference between a Roth and when that might be a good fit for somebody.
Yeah, that's a great question. Get that question a lot. And there's kind of two sides to it, right? Of like, hey, am I just putting money in a Roth, whether it's a Roth side of a 401k or an IRA, or should I be doing Roth conversions is another question that comes up with that. So when you contribute to a traditional retirement account, whether it's a traditional IRA or a 401k, you're either having the money go in pre-tax from your paycheck so that it's never hitting your tax return, or you're getting a tax deduction in the case of a traditional IRA. So the idea is that you're not paying taxes on it the year that it's going into the account. And so you're able to lower your income in the present for that account. And then it's able to grow tax deferred in that account. And then when you are in retirement and you meet all the qualifications, there's, of course, penalties if you pull it out early. So you don't want to fund these accounts, overfund these accounts if you need the cash. But in retirement, when you take money out, instead of paying gains on what happens within the account, you don't do any of that in retirement accounts. When you take the money out, you pay taxes at ordinary income rate. So you don't pay taxes going in, but you pay the taxes coming out. The reason that works for most people is because you're typically earning more money during your earning years. Mm-hmm. And then in retirement, you're only pulling out what you need of the account. So even if you're living a similar lifestyle, well, you're not saving money anymore and you're only taking out what you need. So you're able to have your taxes be in a lower tax bracket in retirement, because that's really where the difference comes in, is the different types of tax brackets. With a Roth, it's the opposite. So you don't get any deduction when you put money into a Roth. It's taxable the year you put it in, but it grows tax deferred. And when you take it out, you don't pay any taxes, which is pretty fantastic.
Yeah. So it's like you choose whether you want to pay taxes on the seed or the harvest. And,
exactly.
And the point is, do you think you're going to be in a higher tax bracket now or when you retire? And that is probably the determining factor on which is right. And maybe you have some of both.
Yeah. So that is the big thing. And there's some, when people are in certain tax brackets, sometimes it's kind of a toss up and it's sometimes more of a preference thing. It's always nice to have people end up with a little bit of both. I like to see kind of a variety of accounts that people have, because then we can really manage their taxes well in retirement. But yes, the real benefit, like with the Roth, for example, is that if you aren't making very much money, but you have money to save, the catch is that a lot of times when people aren't making very much money, they don't have very much money to put into an account. But when you are in a low tax bracket, especially if you're like young and you're a college student, but you have some excess money to throw in there, that's a great time to do that. And you'll get all that growth and be able to have it tax-free in retirement.
Well, and I think that's a really good point that we need to touch on, because the sooner you start your retirement account, the better it's going to grow for you.
Oh, absolutely.
Even if you can only put in $20 a month.
Yeah. Mm-hmm. And the Roth is super powerful in that for people that are in a place where they're, and the Roths have some more flexible distribution allowances too. So there can be some ways to get that money out for some, when you need it, a portion of it.
So if somebody, let's say their debts are paid off, they already have an emergency fund, and they are wanting to start investing, would you recommend immediately expanding your portfolio and having multiple buckets that you're putting into, or would you recommend immediately putting it all into one bucket?
We'd probably focus in one area first. A lot of times when people are a little bit limited, or if they're just starting out, we'll actually start with the taxable brokerage. And and this is assuming they don't have a workplace plan. I always assume they, participate in that workplace plan if they have it. But if they don't have a workplace plan, normally I'll say, hey, let's start with just like a regular account. Let's see how you do. Let's make sure you don't end up, we're not being overly aggressive and you're not like, I actually need this money. And then let's have a subsequent conversation before tax time about if we should take some of that money and do a retirement contribution.
So I think that brings up a really good point. So a lot of people do have a work plan. So if you do, that is just money that's automatically coming out of your paycheck. Hopefully your employer is matching at least some of that. But I feel like those accounts, for me anyway, are out of sight, out of mind. Mm-hmm. There's not somebody that's calling me saying, hey, I think we should adjust this or whatever else. So it's a very different process to have an actual financial advisor on the separate side of things. So if you have a work plan, do you need to do more than that?
Probably. I mean, it depends a lot on everybody's scenario. And in certain situations, maybe that's enough in this season. But most likely going back to the discussion about like a taxable account that can be accessible earlier, if you have goals that are 5 to 10 years out that you're saving for, it's a good idea to have that money invested instead of just sitting in a savings account. If you have big goals where it's like that money can be growing for you. Instead, I'm never wanting to invest money for the 1 or even 1 to 2 year goals. I get a little squishy on because I want that to be available when you need it and not to be subject to market fluctuations. But especially when you're looking out at those longer time horizons, it's great to do that. Or if maybe you're just not sure what the future holds and you want to be socking some money away. And then, with the workplace plans, you can balance those with different things. And also most people change jobs. And so you can roll your old workplace plans over to a financial advisor to have that ongoing management. And you typically have far more options when you do that than within your workplace plans.
So that's a great point. If you have a job that you've left and you have an old 401k, or maybe you have a couple of those, one of the things you can do is roll it into an IRA. Basically, that is a great time in your life to call a financial advisor. And because again, that conversation is going to look different than like if you go into your work plan, it's probably like choose your retirement date, and it's just going to put you in some sort of a fund. But you don't really know what that looks like. So for me, taking that data of here's what I already have, calling you and saying, here's my goals, here's when I want to retire, here's how much money I want to have when I retire, which is a really hard number to come up with for me, by the way. I don't know if I'm the only one, but I was like, I don't know. And then having you say, okay, well, based on what you're doing now, this is how much you're going to have in retirement, or this is when you can retire. But if you do this much extra, then you can have this or this.
Yeah, exactly. And I will say, like, when I work with my clients, I always review with them their workplace plans as well and help them make those selections and navigate that whole process as well. So that's just another piece because we want to look at the whole picture of it.
Will you touch on a little bit? I feel like whenever I have met with a financial advisor, I don't know what I should be investing in. I don't know where it makes the most sense to put my money. And the very first time that I went and met with a financial advisor, I was like, this is how much money I have. Just do what you would do. And that's what she did. And we didn't really have more of a conversation than that. And I very much, like, to this day, I don't really understand what I was even investing in. So will you talk a little bit about that?
Yeah. So I'm a big believer in educating our clients. I have a lot of clients who don't want to know the details, and that's totally fine. You want to pick a financial advisor that you trust. And some people are more or less interested in this. But we do insist on giving our clients an overview of how we invest and why, so they understand it. And it also really helps when we do have seasons of market volatility, because we've given our clients an education to understand what's going on and why they can be confident getting through that season. And so with that, like, first of all, I 100% agree that you should be able to trust your professional. I hear stories of financial advisors where people go in and the advisor says to them, well, what do you want to invest in? And I'm like, well, then what are you there for? And our job is to guide you through that process based on what you need and what we're trying to accomplish. And that's really what matters in this is that your investments accomplish your goals on that side of it. So it's good to lean on your advisor, but it's important to understand the mechanics of what you're investing in, because the stock market, we really only have two things in the investment world. We can own businesses or we can make loans. That's it. All of the other products are based on that. Even owning real estate is a form of owning a business.
Yeah.
And so we've got the stock market, which is owning businesses, and we've got the bond market that is owning loans and making these loans to people. So from that standpoint, what kind of businesses do you want to own? Well, personally, I want to own solid, stable businesses that pay their owners.
I love that.
So that's what we focus on in our investing is that we want to own not everything. You think about, here in Bozeman, would you want to own every business in Bozeman?
Absolutely not. No.
So when people are investing in, the S&P 500, they're just investing in a little bit of everything.
Yeah.
And it's not very hard to pick out some of the losers. It's really hard to pick the things that are going to skyrocket, but it's not hard to eliminate the garbage. And you also want to make sure that it's profitable.
Well, and I think that brings up a really good point about just like what is a quality investment versus what isn't. We were talking off air a little bit about, you know, the gold and silver and crypto and all of these different hot ticket items right now that people are talking about of where they should put their money. So in your opinion, what makes a quality investment?
Yeah. Well, so what we want to look at when we're thinking about businesses are businesses that are making real products or producing real services that people want and buy and pay money for, which produces a profit. And they use that profit to run their business, develop future business, and pay their owners. If those things aren't happening, maybe you're speculating. You're saying someday this will be a profitable business. A lot of things in the AI space are in that bucket where people are betting that somebody's going to pay more for it. And the reason they're betting somebody's going to pay more for it is they're saying someday it will be profitable. So oh, go ahead.
I was just going to say, so when we start talking about that, anytime we get really into speculation like that, that makes me feel a little bit uneasy. And like, you know, we've talked about this a little bit, but I think the AI thing can be a big bubble because it is speculation, right?
It feels like the conversation we had around dating somebody's potential instead of dating the actual person.
I love that. Yes, that's a great analogy. Yeah. And what's a really big concern about that is that right now the valuations are so high on some of these companies that there would have to be astronomical profit in them. And we're not even seeing a path to get there yet. And that's not saying that there are not incredible technologies that are going to change things. This was true in 1999, that the internet was going to change the world, but we still had to get to how it was going to do it. And the valuations that went up on those companies were just so much higher than anything that was realistically going to happen. A fun one to look at is Cisco Services, which is a technology company, not the food company. There's also a food company. But Cisco had a huge run up in the .com bubble and crashed with everything else. Cisco's a fantastic company. It's a phenomenal company. It has been the whole time. It produces real goods and services, but it was valued so incredibly high that it was just not realistic and came down. It is just now coming back to that high price of 2000.
Wow.
Back in 2000. 26 years later.
Wild. I would love, you know, I've basically my entire knowledge of what it looks like to be involved in like who is determining stocks and bonds and prices and managing the stock. Like it's only what I've seen in movies, and I would love to like be a fly on the wall and see what it actually looks like in real life. Cause I'm like, I don't think it's quite like that.
I think it's closer than you think, but
So yeah, but going back to your question about, you know, how we approach investing is, you know, we want to buy real companies doing real things. And that's what gives a basis to the prices that you're paying. And so there's a real reason that those companies have those values because they're paying out cash to their owners, they're producing products, they're producing revenue. All of those things are something that's going on. With that, when you ask questions about things like, you know, gold and silver, I'd ask you, what does gold and silver produce?
jewelry.
Good feelings.
Yeah, but especially
proposals.
And we're not even going to do that with it. So, and you just see that price fluctuate with speculation. So you might get a good season where you might hit it of being able to just like, oh, people are going to want to buy gold in this season, and maybe you'll make some money betting on that in a particular season, but it's not going to drive long-term growth because there's no income being produced by it.
Yeah, that makes total sense. It's just speculation on what the price of that is going to do down the road. So it's kind of like going to Vegas.
And it's the same thing with Bitcoin. There's nothing underlying within that.
Yeah. Okay.
So before we kind of wrap up here, I think I always like to talk about how people get paid. I think that's an important conversation. I like when people ask me how I get paid. So I know different financial advisors get paid different ways, and that probably depends on different accounts. So can you talk about that a little bit for us?
Yeah, absolutely. So from the financial advisor standpoint, there's a couple different, ways we get paid. From, us at our firm, we are fee only advisors. So we charge a fee on the accounts that we manage. One of the ways in which we're a little bit unique in that is that we actually cover all the costs in our client accounts, and we have a very transparent fee structure where we use very few products that have internal fees. That's one of the things to note. Whenever everybody in the financial services gets paid somehow, that's, it's just,
of course,
one
nobody
of those
works for free.
It's one of those industries. So whenever you see, there will be funds, you'll look on Vanguard and they'll say, this is a no load fund. And you say, oh, it's free. It's not free. There's a lot of ways that there's different fees that come out. So, that's just the expense ratio. That's just one place we look at for fees. But there's also, there's sales commissions, there's brokerage commissions, omnibus fees, research fees, and some of these are only disclosed in particular documents, a statement of additional information, and they're disclosed in very bizarre ways, just to make that clear. So when you think a fund doesn't cost you anything, that's just not true, because the people who are putting that together are getting paid somehow.
Well, and I don't think you should be afraid of that.
Absolutely.
First of all, the cheapest is never the best. Let's just be for real. I talk about that with mortgage rates all the time. Like, this is one of your biggest financial decisions. Don't go to the cheapest person. Like, Walmart mortgage is not what you want to buy your house through. And I feel that about financial advising. Like, you wouldn't go talk to Walmart financial advisor and expect to have, your accounts do something good. Like, you are paying for trusted experts, and who better to pay money to than your financial advisor who's managing this money? Like, they want you to make money because then they make more money.
Yep, exactly. And so, and that's a great point, Renee. I bring this up not to say that all the funds are bad or they shouldn't have fees, but just to recognize that you don't get to avoid having those fees just by, doing it myself this way or doing that. Or, I'm going to have an advisor that charges a lower fee, but they put me all in these funds. Well, the funds are going to have a bunch of internal fees. So for us, we charge our fee, and our clients see it on their statements every quarter. And so that it's clear and transparent, because we believe in that it's better to be transparent about it than leaning into all of this kind of hidden fees and things like that. And the investments are more efficient when we're able to do it that way.
Yeah, and that makes total sense to me. And here's the thing that I found with other advisors that work for specific companies. They get paid based on the specific products they sell, not necessarily whether it's the right product for you. And I really, really don't like that. I've had prior financial advisors where every time I went into their office, it wasn't like, tell me about your goals. It was like, let me sell you another insurance product. Let me spend more of your money.
Yep.
And I probably have way too much damn life insurance and long-term care and everything else because of that, because that's how they were making money, is by selling their internal products. And with you guys are an independent firm. I know that's one of the reasons you went independent. You're not required to sell anything. Your fee doesn't change depending on what you sell me. Therefore, you can truly be a fiduciary and give the best interest of the client, and your fee is transparent. And I always love transparency.
Well, I appreciate that. And going back to your question about the ways other advisors get paid, a more traditional old school model is a brokerage model where you get paid on the transaction. So you get a sales commission on transactions. So this would be like your old school stockbrokers, where they weren't charging a fee ongoing on the account for planning and management and all of those things. But instead, each time you bought and sold stocks, they made a commission. And so that's a lot less common now. Sometimes that makes sense for people depending on, what they're holding or different things like that. And then, of course, products like life insurance and annuities, those always have big commission payouts to the professional who sells them.
Yeah. Well, as we wrap up here, I just want to say thank you. Obviously, you've helped me a lot personally, but hopefully this is really helpful for everyone else. If it is, please like, subscribe, share it with somebody else. But I also want them to be able to follow you. So I know financial advisor rules are weird about social media and stuff, but I know you have a newsletter at very least. So how can people get more information or find you?
Absolutely. So you can find us on cocreatefinancial.com. You can sign up for our newsletter on our website. We are on Facebook, so you can follow us on Facebook as well.
I think it's also really important to note, we are in Montana, but they have clients all across the country. So if you're not in Montana, don't feel like you can't reach out, because these guys are amazing resources for you. We obviously love them very much.
Thank you.
Well, thank you so much for tuning in. We appreciate you guys as always, and we will see you next Friday. Here's to empowering each other one story at a time.